Hello and hi everyone. We are here today to share with you about our topic, which is internal and governmental financial auditing and operational auditing. Let me share with you more about this topic. We hope you are enjoying to watch this video. Let me introduce myself first. I am Mimi Maisara binti Nur Hafizan. Now, let's start. Let me explain first about internal financial auditing. The definition of internal financial auditing is an independent, objective assurance and consulting activity designed to add value and improve an organization's operations. It helps an organization accomplish its objective by bringing a systematic, disciplined approach to evaluate and improve the effectiveness of risk management, control, and governance processes. Absolutely, the evolving role of internal auditors emphasizes not only traditional tasks like reviewing information reliability and ensuring compliance, but also a proactive contribution to operational effectiveness, risk management, and overall organizational value. The objectives of internal auditor are more diverse and adaptable, ranging from regulatory compliance to performance improvement consulting. Unlike external auditors, standardized reporting formats emphasizing their tailored work. Now, I will explain about Institute of Internal Auditor Malaysia. It is divided by two, which is Institute of Auditors Principal and Code of Ethics, and the second one is the Institute of Internal Auditor Professional Practice Standards. In the Institute of Auditors Principal and Code of Ethics, there have four of them. The first one is integrity. Integrity establishes trust and thus provides the basis for reliance on their judgment. Next, objectivity. Objectivity is internal auditors maintain professional objectivity in gathering, evaluating and communicating information about process, making balanced assessment without undue influence from personal interest or others. An example of personal interest leading to undue influence could be a senior executive in a company directing business contracts towards a vendor they personally own or have a significant financial interest in, compromising the fair and impartial decision-making process. This conflict of interest may result in decisions that prioritize personal gain over the best interest of the organization. The third one is confidentiality. The internal auditors uphold the value and ownership of information they receive, ensuring that they only disclose if it legally or personally required. And last but not least, competency. The internal auditors apply the knowledge, skill, and experience needed in the performance of internal auditing service. Okay, let's move on to Institute of Internal Auditors Professional Practice Standard. The attribute standards address the characteristics of organizations and parties performing internal audit activities, such as 1100. It is independence and objective. Its slide emphasizes the importance of organizational independence and individual objectivity for internal auditors. Includes individual standards to address organizational independence 110, individual objective 1120, and impairments to independence and objective 1130. Now, the performance standard. It is described that nature of internal audit activities and provide quality criteria against which the performance of these services can be evaluated. Now, I will proceed with ISA 610. ISA 610 titled Using the Work of Internal Auditors is a standard issued by the Internal Auditing and Assurance Standards Board IAASB. This standard provides guidance to external auditors when they intend to use the work of internal auditors in the audit of financial statements. The first one is objective. The primary objective of ISA 610 is to guide external auditors on how to appropriately use the work performed by internal auditors during the external audit of financial statements. Next is responsibilities. ISA 610 outlines the respective responsibilities of external and internal auditors. It emphasizes that the external auditor is ultimately responsible for the audit opinion on the financial statements. And last but not least, evaluation criteria. External auditors are required to evaluate the competence, objective, and the systematic and disciplined approach of the internal audit function. Specific criteria for evaluation include the organizational status and relevant policies and procedures supporting objectivity of internal auditors. Second, the level of competence within the internal audit function and whether the internal audit function applies a systematic and disciplined approach including quality control. Now, I will turn to the issue. For the objectivity issues, if the external auditors determine that the internal audit function lacks of objectivity, and this lack of objectivity is expected to have a significant effect on the internal audit function's work. Competent issue is like if the external auditor determines that the internal audit functions lack the necessary competence to perform the work. Now, it comes to the last issue, which is a nature of work. The function does not apply a systematic and disciplined approach, including quality control.
Hi, my name is Zahira and I will explain the differences between internal and external auditor. Internal auditor is responsible to management and the board. It examines issues related to the company business practices and risks. Moreover, they focus on measuring current performance and finding areas for improvement. Meanwhile, external auditor is responsible to financial statement user who rely on the auditor to add credibility to financial statement. They will examine the financial record and issue opinion regarding the financial statement of the company. Lastly, they focus on proving the accuracy and the veracity of the financial statement. Nevertheless, internal and external auditors share many similarities. First, competency. Second, objectivity. Third, methodology. Last, audit risk model and materiality. Both must be competent as an auditor and must apply knowledge, skills, experience in auditing. For example, a strong understanding of auditing standard and procedure. Next, objectivity. As an auditor, they need to remain objective in performing their work and reporting their result. Both type of auditor need to free themselves from bias and conflict of interest. This means avoiding situation where their personal connection, financial interest, or pre-existing opinion could influence their audit judgment. Moreover, methodology. Both follow a similar methodology in performing their audits, including planning and performing tests of control and substantive tests. Last but not least, audit risk model and materiality. Both consider risk and materiality in deciding the extent of their tests and evaluating results. However, their decision about materiality and risk may differ because external user may have different needs than management or the board. Next, I will explain about guidelines to director on statement of internal control. It is derived from the Turnbull Report 1999 to provide guidance to director of public listed company in making disclosure in their company annual report. Turnbull explanation focus on the positive role in the internal control has to play in an organization, such as explain the key areas that director must pay attention to before they can make a statement regarding their company internal control. Next, emphasize the needs for proper risk assessments. Director should ensure that the company has a comprehensive risk assessment process in place, identifying and evaluating potential risks across all levels of organization. More to evaluate the adequacy and integrity of the company system of internal control. They need to assessing whether the control are designated and implemented effectively to manage the identified risks and prevent material misstatement in the financial reporting. This includes safeguarding assets and ensuring that liabilities are identified and managed. Lastly, directors are also expected to independently consider other areas that are specific to the type of business that they are engaged in by adhering the these guidelines, the auditor can effective to fulfill their responsibility for overseeing and reporting on their company internal control system, ultimately promoting transparency, accountability, and investor confidence. More, governmental financial auditing. Federal and state government employ their own auditing staff to perform audit in much the same way as internal auditor. In Malaysia, the government auditing body is called Jabatan Audit Negara, which report directly to Parliament, providing independent oversight government finance and operation. The primary source of authoritative literature for the performance of government audit is the Audit Manual, which is issued by the Jabatan Audit Negara, standard based on the Audit Act 1957, practice of the OAG, MIA standard, International Organization of Supreme Audit Institution, INTOSAI. There are also work directive instruction as an audition as reference, consist of financial statement of governmental units, government's contract and grant, internal control, fraud, other compliance with the law and regulation, understanding of the financial constitution and other basic law and regulation, level of government and statutory bodies. Last but not least, Audit Act 1957. Use guidance from the Audit Manual. Auditor General is responsible to audit account of First Federation of the state. This encompasses examining the financial statement of federal government and each individual state government. This assessment verify compliance with applicable law, regulation, and financial management principle. Second, fund established in the state or the federal territory, Article 97. This responsibility extends to auditing fund created by the state or the federal government for specific purpose to ensure proper uses and adherence to established guidelines. Third, public authorities such as statutory bodies, government-linked company, and other organizations established under federal or state legislation fall under Auditor General. This ensure financial accountability and transparency with these entities. Fourth, other corporate bodies in receipt of a grant or loan from federation or a state. Organization receive financial assistance from the federal or state government are subject to the Auditor General oversight. This assessment verify the proper utilization of public fund and complying with grant or loan agreement. Last but not least are the fine. The Auditor General mandate may encompass auditing other fund deemed necessary as specific in the relevant law or regulation. This include, for example, auditing trust fund or charitable organization that receive public donation. That's all from me. Thank you.
Hi and Assalamualaikum. My name is Nur Amisha binti Samsul Bahrin. I will continue to explain about audit and reporting requirement, which is Audit Manual. First of all, what is Audit Manual? It is a formal guideline that contains a comprehensive guide designed to assist professional accountants and auditor in conducting audits for various reporting and non-reporting entities. It also ensure responsibility fulfilled by Auditor General. Auditor can use the guide provided and would be able to tailor this procedure based on specific needs and audit objective. There are 5 standard bases that serve different purposes. First, we have Audit Act 1957 that provide legal framework for public sector auditing. Second, JAN practices and experiences which could be related to Federal Consolidated Fund. Third, International Organization of Supreme Audit Institution that provide guidance and facilitate cooperation among Supreme Audit Institution around the world. Next, other Supreme Audit Institution. Lastly, standard used by accounting profession which provide a common framework for financial reporting, ensuring consistency and comparability of financial statement across different entities. For example, MFRS. Move on to the next slide, financial auditing standard. There are 5 financial auditing standards. First, materiality and significant.
The acceptable audit risk and materiality may be lower than in an audit of commercial enterprise. This is because of the sensitivity of government activities and their public accountability. Second, quality control. Public accounting firms that audit government entities in compliance with audit manual must have an appropriate system of internal quality control and participate in an external quality control review program to ensure that performance of audit work maintains in high level of professional standards. Third, compliance auditing. The audit should be designed to provide reasonable assurance of detecting material misstatement resulting from non-compliance with provisions of contract or grants agreements that have a material and direct effect on the financial statement. Fourth, reporting. The audit report must state that the audit was made in accordance with auditing standard. In addition, the report on financial statement must describe the scope of audited tasks on compliance with laws and regulations and internal control and present the result of those tasks or refer to a separate report that include the information. Lastly, audit files and working papers. The audit manual indicates that audit files should be contain sufficient information to enable an experienced reviewer with no previous connection to the audit to ascertain from the audit files evidence that support the auditor's significant conclusion and judgment. Furthermore, reporting requirements of Audit Act 1957. First, essential account and record have not been properly maintained. It is required for all accounts and other records that have been and are properly and faithfully maintained to avoid any significant issue. Second, when monies have not been fully accounted for, this could involve discrepancy in financial record, missing documentation, or inadequate tracking of funds. Third, revenue collected or money expended in contravention of laws or established policies. This is where revenue have been collected or money have been expended in violation of existing law or established policies. This could involve transactions that deviate from legal requirements, regulation, or internal policies governing financial activities. Fourth, monies have been expended other than for purposes for which it was appropriated or approved. Monies such as funds or financial resources have been spent in a manner inconsistent with the purpose for which they were originally appropriated or approved. This could involve expenditure that deviate from budgetary allocations, project plans, or other approved financial plans. Lastly, I will explain to the next slide. This is the continuation from the previous slide. The rules and procedure applied have been insufficient to first, safeguard properties, asset, and share. This is because there is always the possibility of human error or non-compliance. For example, employee or individuals may unintentionally violate standard. Second, insufficient to secure an effective check on assessment, collection, and proper allocation of the revenue and other receipt. For example, insufficient of transparency in financial processes and corruption can lead to the misuse or misallocation of funds. Lastly, insufficient to ensure that expenditure have been made only as authorized. If there is a lack of oversight and monitoring of financial transactions, it becomes easier for individuals to unauthorized expenditure without detection. Now I will explain about general guidance of auditor. First, auditor should have good understanding of federal constitution and other basic law. For example, in terms of ensuring adherence to law, auditor must verify whether the audited entity comply with relevant laws and regulation. A good understanding of the federal constitution and basic law enables auditor to assess compliance accurately. Second, good understanding of Audit Act 1957, audit concept, standard and practices. For example, auditor under Federal Constitution, which is Auditor General, has the power to call upon any person for any explanation and information. Other than that, may authorize any public officer on his behalf to conduct any inquiry, examination or audit and to report thereon to him. That's all from me. I will pass to the next presenter. Thank you.
Hi and Assalamualaikum to everyone watching our video. We would like to say thank you for your attention so far. My name is Nur Syahri binti Halim, and on this slide I will unravel the two types of auditing that serve a distinct purpose in ensuring the integrity, transparency and efficiency of organizational processes. As organizations strive for excellence in governance and performance, they often deploy two main types of audits, which are operational auditing and financial auditing. These audits serve different purposes, focusing on internal processes and financial integrity respectively. I will start explaining the concept of operational auditing first for you guys to have deeper understanding before we go in further. So basically, operational auditing involves assessing efficiency and effectiveness of internal processes. It evaluates how well an organization's internal operation and workflows are performing. This assessment aims to gauge the degree to which these processes are achieving their intended goals and objectives in a streamlined and productive manner to improve the overall performance and identifying area for enhancement. The key focus area of operational auditing includes processes, system, procedures, human resource, marketing and also information system. Meanwhile, for financial auditing, it involves ensuring the accuracy and compliance of financial statement and record. It requires the systematic review and verifications of an organization's financial documentation to confirm that it accurately reflects its financial position and adheres to relevant regulation and standard. The question is, how does auditor actually verifying the precision of financial information? So, auditor will assess whether the numbers reported in financial statement are reliable and reflect the true financial health of the organization by confirming the accuracy of the transaction, balances and other financial data. For compliance, it involves ensuring that the financial statement and record comply with applicable accounting principles, industry regulation and legal requirements. Auditor checks whether the organization is following accepted standards such as generally accepted accounting principles or international financial reporting standard and any specific industry regulations. By conducting audits to ensure accuracy and compliance, auditor can provide assurance on financial information, compliance and preventing fraud. The key focus area for financial auditing includes financial statement, balance sheet, income statement, cash flow, compliance with accounting standard. Next, we will dive deeper into the major contrasts between operational auditing and financial auditing. These differences are not just details, they are the key elements that shape the unique landscape of these two audits. We will uncover the purpose of the audit, explore how reports are distributed, and unveil the fascinating world of non-financial areas. The first differences we will discover is purpose of audit. The purpose of an audit is to systematically examine and evaluate various aspects of organization operation, processes or financial information to ensure accuracy, compliance and reliability. The specific purpose can vary depending on the types of audit being conducted. For operational auditing, the purpose is to evaluate and improve the efficiency, effectiveness and overall performance of an organization's internal processes and system. It involves evaluating systematic review and analysis of various aspects that focuses on non-financial areas such as processes, procedures, systems, human resources, marketing strategies and information system. The primary objective is to identify strengths, weaknesses and area for improvement within this internal operation to enhance the organization's overall efficiency and effectiveness in achieving its goals. For example, consider an organization who wants to assess the efficiency of its supply chain management process. So, the operational audit would involve evaluating the procurement, inventory management and distribution processes to identify bottlenecks, streamline workflows and enhance overall supply chain efficiency. In terms of financial auditing, the purpose is to emphasize whether historical information was correctly recorded to provide assurance. It concerns with ensuring the accuracy and reliability of an organization's financial information regarding the fairness of financial statements, compliance with accounting standard and adherence to legal and regulatory requirements. Financial audits is conducted to detect and prevent financial misstatement or fraud in the reporting of financial results. Why do you think financial auditing is oriented to the past? It is because by examining past financial statements, auditors can understand the trends, identifying areas for improvement, and making informed decisions based on past results. For examples, a publicly traded company is preparing for its financial audit. So, the financial audit would focus on verifying the accuracy of financial statements, examining transactions, and ensuring compliance with accounting standards to provide assurance to investor and regulatory bodies regarding the reliability of the company's financial reporting. The second differences lies in the distributions of report. Distribution refers to the dissemination or sharing of the audit findings and results. The process of how the audit reports is shared with relevant stakeholders is a critical aspect of the audit process. For operational auditing, the operational audit reports are typically distributed to various levels of management within the organization, as the reports are intended primarily for management. The findings and recommendations from operational audit are crucial for management decision making and process improvement. Thus, auditors performing operational audit are employees of the entity and hence controlled by the management. The operational audit report does not have a standard format due to the diverse nature of operational processes and the customized focus of each audit. Unlike financial audit, which follows standardized accounting principles and reporting framework, operational audits cover a wide range of internal processes and systems, making it challenging to establish a one-size-fits-all format. The report may not always be externally disclosed unless required by regulatory or governance standards. Usually, companies that are required to disclose the report are financial institutions, healthcare providers, and publicly traded companies because compliant requirements demand transparency and accountability in their operation. For instance, consider a scenario where a retail company conducts an operational audit to enhance its customer service processes. The operational audit report resulting from this examination is strategically disseminated to various levels of internal management, including department heads and operational managers. The distribution is carefully distributed to ensure that the finding and recommendation reach the relevant stakeholder who can implement changes and enhance customer service effectively. In terms of financial auditing, the reports are typically distributed to external users of financial statements such as shareholders, investors, regulatory bodies, and creditors. The emphasis is on providing external parties with assurance on the accuracy and reliability of organization financial statements. Thus, professionals who are performing financial audit are external auditors that are not controlled by the management. Financial auditing has a standard format primarily due to the need for consistency, comparability, and adherence to established accounting principles and reporting framework. A standardized format ensures that financial statements are prepared and presented uniformly across different organizations, making it easier for stakeholders such as investors, creditors, and regulators to analyze and compare financial information. The report must be published publicly to ensure transparency and accountability. The last differences lies in the inclusions of non-financial areas. It refers to the examination and assessment of aspects beyond traditional financial metrics. For operational auditing, it included non-financial areas such as operational processes, compliance with regulation, internal controls, environmental sustainability, and social responsibility. It examining various internal processes and business functions. This may involve assessing the effectiveness of marketing strategies, the efficiency of production processes, the adequacy of human resource management, and the reliability of information systems. Operational audit consider both financial and non-financial data to provide a comprehensive evaluation of an organization operation. For example, consider a manufacturing company who conduct an operational audit to improve its production efficiency. So, the operational audit will assess the production process, quality control measures, and employee productivity. It considers non-financial factors such as production cycle times and equipment utilization to identify areas for improvement. For financial auditing, it primarily focuses on financial data and statement, hence it do not delve into the operational efficiency or effectiveness of non-financial areas. The scope is limited to matters that directly affect the fairness to financial reporting, ensuring that the organization's financial statement fairly represent its financial position, performance, and cash flow. For example, consider an accounting firm who undergoes a financial audit for regulatory compliance. So, the financial audit will focus on the accuracy of financial statement, adherence to accounting principles, and complying with regulatory standard. It will not delve into the financial areas such as the efficiency of internal communication processes or human resource management. Moving on to the next part, we will be discussing about the overview of operational audit that involve two concepts, which are efficiency and effectiveness, that are often used in the context of organizational performance and management. So, let us go through each concept. The first concept is efficiency. Efficiency refers to the extent to which an organization's internal processes contribute to the achievement of its strategic goals and objectives. It is the ability of the company to accomplish a task or goal with the least amount of resources, time, or effort. It involves maximizing output while minimizing input. Efficiency focuses on whether the organization is doing the right things to meet its overall mission and objective. The mission and objective of an organization is always to reduce waste, minimize costs, and streamline workflow. Efficiency is often measured by metrics such as cost per unit, time per task, resource utilization, and productivity. The goal is to achieve a high levels of output relative to the input. For example, if a manufacturing plant produces more units of product using the same amount of raw materials and labor, it is considered more efficient. The second concept is effectiveness. Effectiveness refers to the accomplishments of objectives with minimal waste, cost, or time. It is about doing the right things to produce the desired outcome. Effectiveness focuses on assessing how well an organization utilizes its resources and is concerned with the end results and whether the organization is accomplishing its mission or purpose. It involves making strategic decisions that align with organizational goals. Effectiveness is measured by the success of achieving goals and objectives. Key performance indicators are often used to assess the impact of organizational activities on desired outcomes. An organization is effective if it meets its customer satisfaction targets, achieves revenue goals, or fulfills its mission. For example, producing parts without any defect. Lastly, I will touch about the types of typical inefficiency. There are 5 typical inefficiency that I would like to discuss. In a company, buying things and getting services can cost a lot if things are not done efficiently. For example, if the company doesn't ask different sellers to compete for the best prices when buying materials, it might end up paying more. Another issue is when the material needed for work are not available when they are supposed to be. This can happen if the company doesn't manage its material and supply chain well, leading to extra costs for rush deliveries. Another problem is when employees do the same work twice, like keeping 2 sets of record for production and accounting. This shows that different parts of the company are not working together and it can waste time and resources. Inefficiency also manifests when work is done that serve no purpose, such as filing vendors' invoices and receiving reports without utilizing them for financial management purposes. Lastly, having an excess of employees beyond operational needs is another inefficiency. For instance, office work could potentially be accomplished with one less assistant, highlighting the need for workforce optimization to mitigate increased labor costs and potential underutilization. Addressing this inefficiency is critical for organizations to enhance productivity, reduce costs, and improve overall operational effectiveness. For the next part, I will pass the floor to the next presenter. That's all from me. Thank you.
Moving to the next part is the relationship between operational auditing and internal control. So there are 3 relationship concepts in this situation. The first one is the reliability of financial reporting. So as we know, management is the person that is responsible to prepare the statement for the investors, creditors, and other users in order for them to review the financial situation of the company. Therefore, the management need to ensure financial information that they prepare is fairly presented and comply with accounting frameworks such as Generally Accepted Accounting Principles (GAAP) and International Financial Reporting Standard (IFRS). So the objective of operational auditing here is to know whether the company effectively present their financial reporting responsibilities. Next is efficiency and effectiveness of operations. So basically, controls within a company will encourage efficient and effective use of its resources to optimize the company's goal. Hence, operational auditing will deal with efficiency and effectiveness of organizations. So the important objective of this control is to see how accurate a company's financial and non-financial information regarding their operations for decision making. Lastly is compliant with applicable laws and regulations. Management of all public companies are required to issue a report regarding the operating effectiveness of internal control over their financial reporting. All companies, either public, non-public and non-profit organizations, need to follow many laws and regulations such as environmental protection, civil rights laws, income tax regulations and others. Hence, failure to comply to those relevant laws and regulations may result in a large fine to the company. There are two things that differentiate the internal control evaluation and testing for financial and operational auditing. So the first one is purpose. So the purpose of operational auditing of internal control is to evaluate efficiency and effectiveness and also make recommendation to management. Operational audit looks beyond financial processes to assess the broader aspects of an organization's operations. So these include areas such as production, logistics, human resources, and other non-financial functions. So for example, operational auditor might test whether internal verification procedures for duplicate sales invoice are effective to ensure the company does not offend their customers and also collect all receivables. While the purpose of financial auditing of internal control is to determine the extent of substantive testing required and report on effectiveness of internal control over financial reporting. Financial audits primarily concentrate on controls related to financial reporting and the accuracy of financial statement. These include controls over revenue recognition, expenditure authorization, financial reporting, and other processes directly impacting financial statements. So, for example, financial auditing might do the same process as operational audit just now, but for different purpose, which to reduce confirmation of account receivable or other substantive tests. The second one is scope. So the scope of operational auditing is any control that affecting the efficiency and effectiveness of organization's operation. So it focuses at the controls throughout the organization to improve overall efficiency and effectiveness beyond just financial processes. So for example, operational audit can focus on policies and procedures established in the marketing department to determine the effectiveness of catalogs in marketing products. While the scope of financial auditing is restricted to the effectiveness of internal control over financial reporting and its effect on fair presentation of financial statements, so this aspect concentrates on controls related to financial processes like revenue recognition, expenditure authorization, and financial reporting. So for example, a financial audit may assess the expenditure authorization such as operating expenses and manufacturing costs to determine whether it is properly approved and recorded. Moving to types of operational audits, there are three broad categories. So the first one is functional audits. Functions act to categorizing the activities of a business such as billing function, production function, payroll function, and others. So functions may be categorized and subdivided in many different ways. So for example, accounting function may be subdivided into cash disbursement, cash receipt, and payroll disbursement function. On top of that, payroll function may also be subdivided into hiring, timekeeping, and payroll disbursement function. So functional audit also deals with one or more functions in an organization. For example, the efficiency and effectiveness of the payroll function for the company as a whole. One benefit of a functional audit is that it allows auditors to specialize. For example, an internal audit staff might have the potential to become highly skilled in a particular field such as production engineering. So if they dedicate all of their time to audits in that area, they can be more effective and efficient. While the disadvantage of functional auditing is that it might lead to the failure of evaluating interrelated functions. So for example, an internal audit staff that dedicate all their time in particular areas such as production engineering function just now might be failed to interact with manufacturing functions and any other functions. The second one is organizational audits. So basically, operational audit of an organization deals with an entire organizational unit such as department, branch, or subsidiary. An organizational audit emphasizes how efficiently and effectively functions interact. For example, an organization will undergo an organizational audit in order to evaluate the company's strategic planning, leadership effectiveness, communication process, and their overall corporate governance. So this type of audit aims to identify areas where the organization can enhance its overall performance and align its various components for better synergy. So the plan of organization and the methods to coordinate the activities are important in this type of audit. The last one is special assignments. So in operational auditing, special assignments audits are specific one-time reviews undertaken to address unique issues or concerns within an organization. So it arises at the request of a management, particular event or challenge for a wide variety of audits. So for example, the audit may take place in order to determine the cause of an ineffective IT system, investigating the possibility of fraud in a department, and also making recommendation for reducing the cost of a manufactured product. Now we are going to discuss regarding who performs the operational audits. So the first one is the internal audits. In this aspect, internal auditors are unique because they also perform operational audits. It means that internal audit department do both operational and financial auditing due to the reason that they spend most of their time working for the company that they are auditing. Internal auditors have an advantage in doing operational audits, so they are also able to develop knowledge regarding the company and its business, which is necessary to effective operational auditing. In order to maximize their effectiveness in both financial and operational auditing, the head of internal audit department must report directly to the audit committee. Internal audit department also must have access to an ongoing communication with audit committee of the board of directors. So the structure will help internal auditors to remain independent. Let's say if the internal auditors report directly to the controller, it will be difficult for them to do an independent evaluation and make recommendation to senior management regarding inefficiencies in the controller's operations. Second entity who performs operational audit is governmental auditors. So different federal and state government auditors perform operational auditing as part of doing the financial audits. One of the most widely recognized government auditor group is GAO, yet many of state government auditors also concerned with their financial and operational audits. So the operational audits are divided into two parts. The first one is economy and efficiency audit. So the purpose of economy and efficiency audit is to determine whether the entity is acquiring, protecting, and using its resources economically and efficiently. For example, GAO may conduct an audit to assess a federal agency's procurement process to ensure it acquires goods and services economically while maintaining quality standards. Secondly, the causes of inefficiencies or uneconomical practices. So, for example, a state government auditor examines a public transportation system, uncovering inefficiencies in road planning, maintenance, or fuel consumption, and recommending improvements. Lastly, whether the entity has complied with laws and regulations concerning matters of economy and efficiency. So, for example, GAO audits a federal agency's IT infrastructure to verify compliance with cybersecurity laws, assessing the cost-effectiveness of cybersecurity measures, and adherence to regulatory frameworks. The second part is program audit. So the purpose of program audit is to determine the extent to which the desired results or benefit established by the legislature or other body are being achieved. For example, a state auditor may audit a funded public health program success in reducing a specific disease's prevalence. Secondly, the effectiveness of organizations, programs, activities, or functions. So for example, GAO may review a federal environmental conservation initiative to determine the effectiveness of conservation efforts. Lastly, whether the entity has complied with laws and regulations applicable to the program. For example, a state government auditor examines a social welfare program to verify compliance with laws and regulations related to eligibility, fund distribution, and service delivery. So the last entity that perform operational audit is a CPA firm. So when a CPA firm does an audit of historical financial statements, the objective is to identify operational problems and also making recommendations that give benefit to the audit client. The recommendations may be made orally or the auditor may include in the management letter. On top of that, the background knowledge about the client's business that external auditor obtain usually provide useful information for giving operational recommendations. For example, when auditor found that the inventory turnover was slow during the current year, the auditor should determine the cause first in order to evaluate the possibility of obsolete inventory that might cause misstatement in financial statements. So the auditors may identify the operational causes such as ineffective inventory acquisition policies that can be brought to the attention of the management. Auditor that has a broad business background and experience in the related business are likely to be effective in providing the clients with relevant operational recommendations than auditor that lacks of those qualities. Client also usually engage a CPA firm to do auditing for one or more specific part of its business. For example, a company can ask the CPA firm to evaluate the efficiency and effectiveness of their computer system. So most of the time, a company engages with CPA firm only when the company does not have an internal audit staff or the internal audit staff lack of expertise in certain areas. So there are situations where the management or board of directors outsource the entire internal audit function to CPA firm or cost sources select internal audit activities such as IT operational auditing activities to be done jointly by CPA firm and certain members of the company's internal audit staff.
My name is Hazika Betty Mak Basri. I will continue the presentation with independent and competence of operational auditor. The first thing I will explain is the independent. The independence of internal auditor is enhanced by having the internal audit department report to the board of directors or president. Similarly, government auditor should report to a level above the operating department. For example, if an operational auditor identify a weakness in inventory control procedure, they should report their finding to the audit committee, not directly to the department responsible for inventory management. Next is competence. Competence is necessary to determine the cause of operational problem and to make appropriate recommendation. The internal audit staff doing that type of operational auditing will presumably have to include some personnel with background in marketing and other in production. For example, building relationship with stakeholders. To gain trust and ensure the objection of their recommendation, operational auditor need to build positive relationship with management, department head, and other stakeholders. This envelope active listening, empathy, and clear communication. Now is criteria for evaluating efficiency and effectiveness. There are two criteria, which is specific criteria and source criteria. Now is plan and perform an operational audit. First is specific criteria. Most specific criteria are usually desirable before starting an operational audit. For example, purpose that you are doing an operation audit or of the equipment layout in plan of a company. Here are some specific criteria stated as question that might be used to evaluate plan layouts. The first one is where all plan layouts approved by Home Office Engineering at the time of original design. Second, has Home Office Engineering done a revaluation study of plan layout in the past 5 years? Third is each piece of equipment operating at 16% of capacity or more of at least 3 months each year. This is continuation of previous slides. Fourth is does layout facilitate the movement of new material to the production floor? Fifth is does layout facilitate the production of finished goods? Sixth is does layout facilitate the movement of finished goods to distribution center? Seven is does the plan layout effectively use existing equipment? And the last one is the safety of employee endangered by the plan layout? Now I will present about operational auditing criteria sources. Historical performance based on actual result from previous period. Auditor can determine whether things have become better or worse. The advantages about this is it easy to derive. Historical performance data is readily available and does not require complex calculation or external benchmark. This makes it a convenient and accessible approach for auditor. For example, sales growth. A company might compare its current year's sales figure to those of the previous year to evaluate growth or decline. Second, benchmarking. Entity within or outside the client organization may be sufficiently similar to the client organization to use their result as criteria. The advantages of benchmarking is identification of best practice. Benchmarking against high-performing entity allows auditor to identify best practice and successful strategy that the client organization can potentially adopt. This can lead to significant perform improvement. For example, retail store. A small collecting boutique might benchmark its inventory turnover rate against other boutiques in the same city or with similar target audience. This can reveal how efficiently they manage their stock and identify opportunity for improvement. This is the continuation of previous slides. Fourth is engineer standard. Auditor can use time and motion study to determine efficient production output rate. The advantages of engineer standard is improved accuracy and consistency. Compared to subjective or historical benchmark, engineer standard offer greater accuracy and consistency in perform evaluation. This leads to more reliable conclusion and reduce the risk of bias. For example, is time and motion study. This study analyzes the movement and time taken by workers to perform specific tasks, such as the assembling a product or operating a machine. This data can be used to set benchmark for efficient product rates, identifying areas for improvement and potential automation opportunity. The last one is discussion and agreement. This party envelope should include management of the entity to be audited, the operational auditor, and the entity or the person to whom the finding will be reported. The advantages of discussion and agreement is incorporation of context. Discussion enables the inclusion of the organization's unique circumstances, challenge, and goal within the established criteria. This results in contextually relevant audit parameters that avoid unrealistic expectations. For example of discussion and agreement is assessing the efficiency of this complex supply chains. While historical data and industry benchmark can provide insight, discussion with logistic personnel, supplier, and production team can reveal hidden efficiency and lead to customized criteria for evaluating workforce optimization.
My name is Noraina Sofrina Hasbullah. I will continue with the three phases in an operational audit, which are planning, evidence accumulation and evaluation, as well as reporting and follow-up. So, let us first look at the first phase in operational auditing. In planning, it involves scope of engagement, staffing, background information, understanding internal control, and decide and appropriate evidence. Now, I will explain each necessity of those items. For the scope of engagement, it often refers to boundaries of the audit. It specifically states what will and will not be included in the engagement. So, why this need to be done? It actually to ensure efficient resource allocation, minimize confusion, and help in maintaining clear expectation for both auditors and the auditee. Operational audits cover a wide range of areas within organization, from financial transaction to IT system and too many others. So, unlike financial audit, this will create diversity which make it difficult to decide on specific objectives. For example, I am planning in procurement department in a large manufacturing company. So some potential objectives that I should consider is ensuring compliance with company purchasing policies and procedures, evaluating the effectiveness of supplier selections and negotiation process, or I should assess the efficiency of inventory management practices. The next one is staffing. Staffing refers to the process of assigning the right people to the audit team. Those people should have the necessary skills and experience to effectively conduct the audit and accomplish the audit objectives. Actually, the success of any audit doesn't matter whether it is financial or operational audit. It will always hinge on the competence and expertise of the auditor team. The example could be the auditor may need an engineering background to evaluate performance on a major construction company. This seems to be more complicated than financial auditing, isn't it? So yeah. Next one is background information. Of course, it is necessary to obtain background information about the organizational unit. So we as an auditor can develop a comprehensive understanding of the unit that being audited. For instance, to review the organizational structure, maybe the auditor can propose questions like who report to whom within the unit and etc. Now, let's move to the next one, which is understanding internal control. Understanding internal control in the planning phase allows operational audit to tailor the audit approach to address the specific vulnerabilities and ensure a more effective and targeted examination of the organizational unit. Okay, the last one is to decide and appropriate evidence. This determines the strength and persuasiveness of auditors' subsequent findings and recommendations. It involves identifying the type and amount of evidence needed to support the audit objective effectively. In particular, if the audit objective is to assess the effectiveness of project management practices in the R&D department, the appropriate evidence would be like project timelines, meeting minutes, employee satisfaction survey or turnover rate within R&D teams, and etc. The next phases in operational audit is evidence accumulation and evaluation. In these phases, there are 4 common evidence that being used extensively in operational audit, which is documentation, client inquiry, analytical procedures, and also observation. It's not that the other type of evidence are not applicable. Certainly, they are equally applicable, but they are not relevant for the most operational audit. Okay. For instance, imagine evaluating the construction companies. The evidence accumulation will include reviewing key documents such as contracts, blueprints, project schedules, and etc. Observing construction processes such as materials handling, equipment usage, task completion also include in evidence accumulation. For client inquiry, the auditor should interview project manager, engineers, and site workers to understand their insight. And in the evidence evaluation, the auditor will compare evidence to establish standards and obligations, such as analyzing project documentation against company policies, contractual regulations, and industry best practices. Or the auditor can evaluate internal controls by assessing the effectiveness of internal control in mitigating identified risks. So now, the last phases in operational audit is reporting and follow-up. There are 2 major differences in operating and financial auditing reports. The first one, the operational auditing report usually sent only to management. This is because without the third-party users, the report does not need for standardized wording since it can oversimplify findings and fail to capture the unique traces of each department and function. The second differences is the diversity of operational audit require a tailoring of each report to address the scope of audit, findings, and recommendation. As for the follow-up, the auditor will make recommendation to management to determine whether the recommended changes were made, and if not, why not. Moving on to example of operational audit findings. The first one is outside janitorial firms save $160,000. The finding is that the audit disclosed the cost of the janitorial services were excessive compared to the similar services performed by outside janitorial firms. The auditors also found many janitorial tasks were not completed as required, which caused in unacceptable quality. So after auditors' recommendation to seek competitive bids, the resultant contract saved more than $160,000 and the quality of the cleaning improved noticeably. The second one is the use of the right tools. In a company that lists 25 heavy-duty trucks for services employers who install and repair vending machines, the internal auditor found that only a few of the trucks were actually delivering and picking up vending machines. So the auditor recommend for most of the heavy-duty truck to be phased out and replaced with conventional light vans, which result in saving of lease rates and also operating expenses. The last one, computer programs save manual labor. How this happened? So the finding shows that the Employee Retirement Income Secretary Act (ERISA) requires an annual audit of profit sharing plans. The IT auditors on the team developed several computer-assisted audit programs to test control over enrollment in and termination from the company's profit sharing. When shown the result of the audit, management corrected all of the problems and instituted additional control to prevent future problems. And the additional control in the programs to detect enrollment errors were used periodically by the profit sharing plan manager. Okay. Another example of the findings in operational audit is enhanced inventory management. So the finding is an audit revealed overstocking of certain items and understocking of others due to inaccurate forecasting and ordering practices. So the organization implemented improved forecasting techniques, adopted safety stock models, and collaborated with sales teams to align production with demand. This led to 15% reduction in inventory, holding costs, improved product availability, and also increased sales. The next one is cybersecurity controls strengthen data protection. An audit of an organization's IT infrastructure identified vulnerabilities in cybersecurity controls, including lack of employee training and outdated security protocol, which increased the risk of data breaches and cyber attacks. So the organization lacked strong password policies, had outdated software, and did not have adequate data encryption or incident response protocols. This exposed sensitive data and critical systems to potential hacking attempts. So the organization implemented mandatory security awareness training for employees, updated software and system, and established strong password policy. So this led to a significant reduction in security incidents and improved overall data protection. So that's all from me. Thank you.